TGIF Warriors. Hope everyone had a good week.
TGIF, Dale, and everybody.
Yeah, TGIF came in. So, how's everyone doing? We're doing all right.
Yeah, all good here.
All right, Jan, I see some new people here. Okay, and VP, nice to meet you. So I just want to say hi to everyone. Jays, how are you? Suhel, nice to meet you. It's a webinar for all skill levels. Welcome to F.A.C.E. We're here every day, same time, same station. Okay. All right.
Just like us, Dale. We are of all skill levels. Some days,
yeah, we all.
Some days we're good. Some days we drop back to the bottom of the ladder.
I was going to say, sometimes my skill level definitely varies from day to day. So just.
Yeah, I know what you mean. I'm trying to get a handle on that. So we have multiple personality disorder here. Welcome.
Hey, good morning, guys. By the way,
hey, Blake, how are you, man?
You know, it's Friday, and it's been the shortest, longest week I've ever had. I think.
Yeah.
Anyway, I'll let you continue on.
All
I just
right.
want to say good morning.
All right. So, I think the chart in the dollar reflects that we're in an indecision pattern here. It could be a descending triangle. I mean, we know where the break comes now. Thought it was interesting how it held the prior low from a few days ago. Underneath 97.27, you could get to 95.5 in a hurry. But you also you can't rule out breakout over 99 and, one more hurrah. One thing that tells me that's a possibility is I keep looking for closes over 1040 that will hold. So, I mean, we had one here and it didn't hold. Sure looked like we were going to hold it yesterday, and so far we're not. So I still lean towards the dollar making the top and not making a new high, but just, want to throw it out there. What are you thinking?
Could it be the end of the month? We are seeing this. It's a possibility, right? Euro dollar yesterday, the highs were printed on the fixings. And from then on, it started to ebb away again. So call it one of flows, but they are still flows. But we did the high euro dollar on the fixing, and that coincided with that support level on the Dixie. And a few tech levels in the euro.
Yeah.
Now we are, sorry?
Yeah, go ahead.
And now we are 100 points lower. I still can't buy euros with the situation going on. I think it's going to last longer than just the end of the possible end of the situation in Ukraine. Europe is going to be under pressure, but I'm not sure if it's going to express itself versus the dollar, or as we are seeing now versus other currencies, right? Euro against the antipodians are not at new lows, because those were printed famously beginning of last week, but they are very weak still.
I don't think we make new lows here, Kman.
I'm sorry?
I have euro pound up. I don't think we make new lows here.
No.
I'm all over 50 to 61.8% retrace on here.
But
the euro, if you're right, and the euro retests or takes out the low, and we end up with at 50% would be really showing strength. But here, I think, as far as relative strength. Yeah.
I agree on the sterling. I was rather talking about like euro versus antipodians versus oil currencies. Sterling is a different animal, in my opinion. Bank of England made it clear again that they are hiking just because of inflation, not because of strength, not growth.
Right.
So there's the uncertainty in the sterling. I'd rather trade that one in a range, to be honest, euro sterling.
So I have an interesting situation. I guess I'm using Steve's setup here, and I can't find this red line. See how this red line showed a breakout here, and then it pulled back and went to it on the S&Ps. But then when I go to the daily, that line disappears, and this is the one I drew for this falling wedge, and it looked like we're trying to break out with not much follow through, at least so far.
Like a side.
Yeah. What do
Sideways breakout, right?
Yeah, sideways.
It's like normally that points to consolidation.
Yeah, I mean,
that tech wizard, to be honest. Did you want to look at anything else before?
No, what do you tell me? I'm
just quickly on the yen.
Yeah, okay.
So we had the Bank of Japan overnight. They did not change anything at all. Kuroda is still very much on the easing path. Says that energy costs alone will not take their inflation to the 2% goal. So he's continuing to ease. So the dollar yen and some yen pairs are picking up again.
Yeah.
But there is one thing I would say interesting, and which is now putting me on the cautious side in dollar yen or in yen pairs, is that we had another guy from the government saying that they are monitoring the pace of the yen weakening.
Okay.
And that comes together with what happened a couple of days ago, where Suzuki, the finance minister, said that weaker yen would only make things worse for importers. It's the Japanese chief cabinet secretary who said that. Stability in the currency market is important. Sharp moves are undesirable. We are nowhere near interventions because, as people might know, there are at different levels, right? There's different graduations in risk for intervention in the yen. But at 120 may spur a little bit a bit more comments. That was my view on the yen. So I'm starting to be a bit cautious here on dollar yen.
Morning. I just want to say one thing. I read somewhere about this. One of the things they said that the BOJ said, which was, we see absolutely no reason to hike rates, no reason whatsoever, or something like that, to hike rates. I mean, that's pretty much as dovish as it gets. And I was looking at CPI, which came in today as well, 0.9% year on year. I mean, how do they do that? They import everything.
That's what I was talking about in the. I was asked exactly the same question in the chat room this morning, and the clue in CPI not going higher is the C. The PPI is flying, the producer for the producers, but the CPI they just do not pass the hikes to the customers, to the consumer, and that's where they bank on the governments to come in with stimulus packages to give them tax rebates and help on that side. There's something special about the Japanese CPI.
Well, they can't keep doing this forever, right? They can't keep taking the whole cost and not passing it on to the customer, because then there's going to be no business left.
Well, they operate just like ForexAnalytix. We don't pass on our prices to the higher prices to our clients either. That's crazy.
The rest of the costs is indeed companies suffering in silence, but they do get tax rebates for not passing on.
Yeah, but who pays for the tax rebates?
The government.
Who pays the government?
There is no government in the world that has its own money. Where does the government get its money from, Kman?
Well, where do you think they get it from?
Exactly. Exactly. So they get it from creating inflation.
Japan, that's what we've been saying for ages, right? Bank of Japan is easing into infinity.
Yeah, and let me
stop.
And let me give you a prediction about the future. Bank of Japan is one more central bank that is claiming that what they really want is higher inflation, but what they really don't want is higher inflation, because as it happened with the rest, they were crying wolf for so long that they want supposedly higher inflation, and then when they got their wish fulfilled, they now have no idea what to do with it.
Japan is on a different planet in most of those things, and the way they look at it, especially.
There are big differences with Japan. I agree 100% with you. But at the end of the day, there is also a limit, even in Japan, of how much inflation you can create.
I've been doing MMT for 2 decades. Huh?
Yeah, before it starts spilling over to to consumer prices. And what you just described yourself already is actually spilling over to consumer prices, but for the time being, there is a backstop to it. But as Stel said, for how long will they be possible?
That's a question to ask the Japanese government. What's the number of the stimulus package that they did? Number 364 or something. Okay.
Yeah, but nothing is unlimited. That's the point.
We should do a webinar about Japan, Steve.
Yeah, nothing is unlimited though in this world.
Yeah.
So the Fed hikes a measly 25, and it was a, buy the rumor, sell the fact on the Fed, at least so far. What do you guys think? I mean, it's still, rates are, still up pretty good on the week, but a little bit of a tail here. Wick.
I reckon it's going to hang around there for a while.
Looks like the yen weaker.
There's one big risk for the dollar is that, and they're guarding themselves from doing it. They are not stepping in now. But if the US ever gets more deeply involved into the Russian situation, then the dollar is going to get hammered, right?
Why?
Sorry?
Why do you think?
Because then you lose a part of your safe haven state for investment money. You have to look at it from an investor's point of view, right?
Right.
Not from a technical. I mean, technical, yes, but the money flow could be adverse versus the US if the US really gets involved.
You're like the smartest kid in the classroom, man.
Sorry?
You're the smartest kid in the classroom.
Yeah,
remember when you were going to school, there was one guy.
I waited 58. That's only very recent. I waited 58.
It's recent. Yeah,
it's always that one guy, Dale. It's that one guy. I wasn't that guy. I'll tell you that much.
Yeah, me either.
Me neither. That guy was my brother.
I learned economics by the kick in the bum.
He's a character. All right. So, a lot of action everywhere. What's conclusive at the end of the week? If you had one instrument to say, you know what, this showed its colors this week. Is there anything for you guys? That's what I thought.
On which one?
The yen kept confirming the move, but is there anything?
I was going to say there's a couple things for me, but I'll wait.
Go ahead.
I'll wait.
No, all right. Well, forces to admit that there is no comeback. It doesn't retrace. We can argue it retraced a little bit after the FOMC, but that was like the rest of the dollars. The yen itself doesn't retrace, right? We are above, even in the euro, which is undergoing pressures due to the situation in Ukraine. Even euro yen is above 131. That's where we were when the whole thing started.
Yeah, so you're asking about what showed its colors. Well, you could say the dollar yen, and do you mind if I take the charts really quick?
No, I never mind that.
Yeah, well, let me grab the correct chart. One of the things that we were talking about, and I can't recall if we were talking about this yesterday on this particular webinar. If we were I would definitely talk about it during the morning edge and the daily roundup. Which are the ForexAnalytix webinars and specifically for ForexAnalytix clients. But I was just talking about how we're very overbought with relative strength, and I was trying to draw out yesterday how we'd get some sort of consolidation as relative strength works off overbought conditions. Well, this is a great example of overbought conditions working themselves off and hitting new highs. So what happens, what can happen here is price could still consolidate, like this, price can still consolidate at its highs, and relative strength will then, continue to move lower. And then at some point, you're going to start to see relative strength break out again. And that's how, we surge past 120 and make new highs. So whenever, if you're a technical trader and you only trade technical charts, which I think is very dangerous. You have to take to account what's happening around you. That's why it's important to, whether it's here or listen somewhere else, you kind of understand the themes and what's going on behind the scenes. And then you use your charts to help time your entries or whatever. But if you rely just on charts and you're like, well, everything that I'm looking at is overbought, so I'm not, it can't go any higher, so I'm going to start selling it. That's not, what you should take into account other things. Obviously we have a big breakout right here. So when you ask, did the dollar yen show, or what showed its colors? Dollar yen. You know what else showed its colors, Dale? And anybody else that's listening? The euro. What a failure yesterday. Wouldn't you say, Kman?
Yeah.
Yeah. We were talking about that level, right? 111, what was it, like 20?
Huge.
20, 30,
1040 was...
It was a huge failure. And as I told all of our traders yesterday multiple times, I'm like, and I explained the whole reason why. I'm like, unless there's some sort of ceasefire in Russia or Ukraine, excuse me, that this is going to stay pressured. Not saying that the euro is going to parity right now, but it's going to have a hard time rallying. But technically, and if you're just a technician and you're like, I just look at charts. Well, then you should have known this failure. I mean, this is like a perfect failure in all textbook here, because if you go back and you look at, this is a weekly chart now. We're now viewing multi-decades worth of euro data as the euro has been released. You take the highs, back in 2008, highs in 2011, highs in 2014, 2018, the pivot and breakout that we made in 2020 post-COVID lockdowns, and then, the retest. Okay. And then now I'm back on, really zooming in. The retest, the breakdown, we came back to retest that breakdown point and failed yesterday. Twice, I guess you can say, Dale. Yeah, you're correct. We failed big time yesterday. And so now, this is really where we're stuck. And everybody should know this right now. It's between 108 and 111. Do I have a good sense if we're going to break 111 or 108? No, but I will tell you this much. I don't think we're going to break back above 111 unless there's some sort of ceasefire or de-escalation of whatever's happening in Russia and Ukraine. And the longer this drags out, the more the risk is that we actually break through parity or break through 108 and start looking at parity again. And that, that's the longer this drags out, and you have to think about, central banks at that point. We have, let's fast forward 30 days from now, and let's say this is still dragging on, right? So now you have the Federal Reserve that has to continue to raise rates because they're trying to fight inflation. Inflationary pressures are continuing to get worse, but the ECB is stuck between a rock and a hard place where they can't really move too aggressively because of what's happening in Ukraine and the fragility of the whole European situation because of higher rates and slower economy because of what's happening in Ukraine and Russia. So they're going to be stuck really as the Fed has to continue to raise rates. And so that could be the catalyst that drives the euro lower over time if the euro or if this whole situation continues to drag on. And there are I could ask any one of your opinions and I'm going to get different answers because you guys at home are going to have so many different opinions about what's happening with Russia and Ukraine and whether it's going to continue or de-escalate. And obviously I can't make that call right now, but that really showed its colors yesterday. So going back to your original question, to your point, Dale.
Okay.
What showed its colors? Yen and euro. Like clear as day, the last 24 hours. Stelios, how about you? What do you think has been very clear aside from we have to buy gold again? I'm joking.
For the very short term,
yeah,
I think what I think is becoming a little bit clear and actually surprised me a bit is that I think equities are the path of least resistance is still higher now.
Yeah.
I didn't think I would be saying this, but I think I think it is for the next few days at least. And we have triple witching today, remember? So
How about that? Do look at my charts. What do you see there? Yeah, we got a little double bottom in the S&P, right?
Yes.
Yeah.
In the short term, I think,
So the S&P or markets are going higher. Why? With everything that's happening. I mean, rates are going higher. We got Russia, Ukraine. Is this the wall of worry, or am I worrying too much?
The bullish argument is there are no bulls. That's it.
Yeah,
is that it?
Right.
I really think that's the main bullish argument, right?
That argument is full of holes. Trust me, after 15 years of non-stop quantitative easing and practically a non-stop uptrend, with the little exception of the, what was it, 1.5 months of sell-off due to COVID, I think there are plenty of bulls around us. Right?
Steve, I still believe that I still believe money is flowing, but I think Paul nailed it
exactly.
And he said money's moving out of Europe into the U.S. Yeah, exactly. And guess who's supposed to? Guess who might cut rates this weekend?
Huh? Oh, China.
You're saying it wrong. It's China.
Okay, so
that's what I've been saying as well. When we saw the U.S. stocks hold up and the Europeans going down, there's been a reshuffle from Europe into the U.S.
Yeah, so I'm gonna agree with Steve here. I don't think that there's lack of buyers. I think buyers are just shifting money. It's just portfolio managers haven't completely crapped the bed globally, where they say I need to get out of everything. We haven't gotten to that capitulation, like sell everything. Right now, it's all about, risk management and portfolio shuffling, I think is what you said, Kman. And I mean, if I'm an asset manager with a couple billion under management, AUM, I'm like, okay, well, let's get out of these markets and put some money over here, and let's put some money to work over at the, some of the, mid cap US stocks. Those seem to be isolated from all this. That's all that's happening right now, right? So, yeah. I mean, so anyway,
and that what may be happening to the other side, if ever, which it's not the base case, but if ever the US gets more involved with the Russian situation and kicks against China's shins, is that we see from peak bearishness European stocks back into back a part of the US back into European stocks, because that's what big money managers might be doing.
Yeah, right.
And then all of a sudden you see the DAX rally 5% and the S&P not moving an inch.
Yeah, and that could very easily happen. And speaking of the DAX, I mean, the DAX is actually flagging here, but we're coming up into some pretty big resistance, which is going to be that it's the 618 right now, but it's all of this previous support. We're going to be facing that very soon. So you got to be real careful chasing the market up here, or just, know what's right in front of you. Mike asked, is that priced in with China? I think the markets would be pretty disappointed if we didn't see some sort of action from China over the weekend. And that we have to think about, if China just, I don't know if that's really what's going to happen, but I think that's what people need to be thinking is what if China, just stands idly by? Well, then, markets might come under pressure then at that point. So we'll see. We'll see. Thank you, Stelios, for bringing up the markets or the stock market. Steve, is there anything that jumps out for you? Dale asked a great question here.
I'm here. Steve is sleeping.
Okay,
well, Greg,
go ahead.
Good to hear from you. I'm well, since Steve is sleeping, how about you? What sticks out in your mind?
Actually, I'm expecting more euro-dollar weakness, but I would also next week bring attention to dollar Mexican peso. I think that dollar Mexican peso could see more weakness. We have a rate decision next week. CPI, as I know, were quite strong, and dollar Mexican peso was trading lower even before this shift has turned, this shift in trends has turned recently into the stronger commodity currencies. So I think that Mexican peso could easily move towards 20 next week.
I do not disagree with you either. That it's definitely showing its.
And have a look at Euromex, it's breaking.
Huh? What? Sorry.
Have a look at Euromex, it's breaking.
Yeah, new lows.
Yeah. Oh, yeah. That, and this is one of those, I brought this chart up weeks ago. And, when people are like, oh, hey, we're at wedge support. I'm like, yeah, but we're below that 618 retracement. And it, when you have, it's price action, right? Like when something doesn't go up, it usually has one other direction to go. Or, if something doesn't go down, it's usually got one other direction to go. So this is like one of those, it was here. And it's at support and it's not rallying. Like no one's finding value in it at these levels. And when no one finds value at these levels, then that means the next level is probably lower. So that's, one of those types of situations. So yeah, good point, Greg. I like the dollar mex, and thanks for bringing that up. Kate, is there anything else that you guys see? I mean, that really stood out to you this week? I could actually go into a couple other things that I see that are really standouts, but we've talked a lot about like these commodity currencies. They continue to look really strong.
Yeah.
They do. They're outperforming, and my 2 cents is they didn't go down when markets were under pressure. So what happens when or if stocks go up? What if China is accommodative over the weekend? What if the S&P completes its double bottom? Which, by the way, I'm all about fading the S&P as we reach up towards the 4,600 level. I'll see what's happening at that point in time, but it's not like I'm going to stick out an order and start selling it there. But my question would be, well, what happens if the S&P does one of these? It really starts to move higher. What happens with commodity currencies that have not gone down? That old adage, Dale. We talk about it all the time, and I always like to explain it this way. It's like a beach ball that you've been trying to push underwater, and it's not going, and eventually you just get so tired and you just let it go, and it pops right out of the water, right?
It's like a headwind turning into a tailwind.
Yeah, I mean that's exactly what it is, and that's how I feel about these commodity currencies. That they do not go down, and same with the yen. The dollar yen, the yen will not strengthen. All the yen pairs continue to go up. So it's that beach ball. You continue to put pressure on them, and then at some point the market gets tired, and the market says, you know what, I'm done. I can't push anymore. And that's what, creates that upside pressure, where it pops right out of the water. And I think you have to be really careful with these commodity currencies. I know a lot of people believe that commodities have peaked, and they are, they're going to consolidate and maybe pull back a little bit near term. And that's probably very true when you start dealing with, commodities, as far as, straight up commodities. You got like, well, maybe cotton's not a good example. Maybe like you got like wheat, or
wheat's come off.
Yeah, wheat's come off. Maybe you got like the palladiums come off a little bit.
Yeah.
You have some of these commodities that are come off a little bit. Yeah, but do you feel like they're going to reverse? Answer that question is probably not. So the currency market is now playing a little bit of like repositioning with you think about asset managers or portfolio managers or central banks are like, we need to be positioned more in, have our reserves more in, Australian dollars versus US dollars or vice or something like that. And you'll get the Titanic in the FX. We talked about this in our chat room yesterday. That's why I'm thinking about it. We get the Titanic type of trends shifting. I say Titanic like the ship, shifting in the markets where you get people more favoring commodity currencies, longer term. And that shift is not like a flick of a switch and it just automatically happens. These correlations and these trends take a long time to develop. And that's one of the beauties of trading currencies. Speaking of beauties of trading currencies, and then I'm going to take your last comments here before we turn it over to Dale. Guys, if you haven't tried the Trader Funding Program, and since this is a free webinar, this is the sponsor of your webinar. So, listen to this for a second. If you haven't tried out the Trader Funding Program, check it out. It is a way that you as a trader can have a small assessment fee to try to access, if you think you're a good trader, you can try to access some of these larger account balances. We have multiple traders in the last 3 weeks that we launched this program have gone through the assessment and are trading these dollar amount accounts now. And check it out.
Fantastic.
It's cool. It's an opportunity for you guys that maybe don't want to trade your own money. You don't want to risk your own money, or maybe you just don't have access to a lot of money and you want to have access to larger trading, larger capital. Well, watch this video, and I'll put the link to the site in our chat box so you guys can check it out. It's really, oops, I was just putting in an update to you can see intraday update, big rejection of the neckline in crude oil market. Oh, that's what I did that earlier. That's that went out to all the ForexAnalytix subscribers earlier. There we go. All right. So now I just put that in the chat box for everybody. So any last minute comments for you guys and gals before the folks here, before we let everybody go?
Yeah.
Kman.
Yeah, the Canadian retail sales just came out better than expected, but they are January data, so I wouldn't expect too much of an impact. But
speaking of the dollar CAD,
quite a bit better. And then we can't forget that Biden and Xi are having a call today in a couple of hours, or in an hour or so. Most don't, well, the expectations are extremely low, but I would not completely rule out some algo trading on the back of words being said by one or the other. So when they are speaking, when we will hear the lines, we may see some odd moves in the market then. But the expectations for an outcome is virtually zero, right?
It's in 30 minutes. I'm going to be a fly on the wall.
Okie dokie.
All right. So,
Stelios, you have anything? I know it's Friday.
No, I'm good.
You're playing pool at your house with a glass of wine. I see it right now, and you've got us on a headphone. Steve, you have anything for us?
Steve is gone. Actually, he's going to get his son, so he's.
Oh, okay. All right. Sounds good. And then Grega?
No, actually, as I said, dollar Mexican peso to the downside, euro dollar also. I think euro in general will stay weak.
I like it. All right. Well, hey, thank you guys. Dale, thank you as always for being here this week. Thanks for another great week with us. And you have a really interesting interview coming up.
Yeah, it was a request from someone in our community, and I've interviewed Rohit a few times, but kind of fell out of the rotation. I'm glad. And you guys, if you have favorites that I've brought on, feel free to let me know. I have a pretty deep book of people we've talked to, but if you want to hear somebody, thank you for reminding me of Rohit. So
we got a request for Jay Powell. Can you get Jay Powell on here?
There is a fake Jay Powell account on Twitter where the guy, not really Jay Powell, it's pretty good. So I'll invite him.
Yeah.
And,
all right, guys.
I've one last thing to add, and that's this is really a great team, and all these guys really work hard and they care about what happens to you and your journey as a trader. So that's what I had to add. And I want to welcome Rohit back to F.A.C.E. Welcome back, buddy. It's been a long time.
Hi, thanks a lot, Dale, for having me here.
So see how popular you are. I try to, forget about you, and your fans come in and say, bring Rohit back, bring him back. So great to have you, because I remember your analysis. Are you going to be sharing your screen today, buddy?
Surely.
Okay, so it's a green box. I'm sure you've used Zoom in the last few years. Everyone has used Zoom.
The last time we did this, my wife heard you speak and she fell off the chair. She really loved your voice and the way you conduct the entire session. So it's really wonderful too.
It's great to be back. Tell me if my memory is good. Like, I remember when we first started talking, you had a narrative of disinflation, and you were kind of bearish. And then it was, I think, what was it, a year ago or longer since we talked?
June 2020 when I made the switch.
Gosh, almost 2 years. So I remember back then you had flipped. You said, Dale, I'm not bearish anymore, and I think inflation is coming back to the markets, and you were bullish equities, and that was a
commodities.
Commodities, and that was a great call. You were ahead of the curve. So how about now? Where are we at? Do you think commodities can take a breather?
So I think we are at a very, very good, interesting juncture because of a lot of what has happened recently. We definitely had what I called in May of 2020 the reflation trade, which meant that the dollar would fall and would drive up asset prices across. Yes. And now in the last 1 year, we've also had the correction in the dollar. The amazing thing with this particular dollar rally is that, and say I called it a correction, even though it's a rally, is that it hasn't had all the same side effects that it had in the previous dollar rallies that we saw between 2009 and 2020. So I continue to call it a counter trend move because commodity prices have been rising along with the dollar. Precious metals haven't really sold off that badly. And in the last 1 month, thanks to the unfortunate Russian and Ukraine crisis, we've ended up with a lot of sentimental extremes in many of these markets simultaneously. And I'm referring to, of course, the daily sentiment index published by Trade Futures. For the dollar index hitting 92% recently, but simultaneously, you saw the S&P hitting, almost 11-12% or 9% at one point of time during this sell-off. We've also seen that in oil, consistent readings at, over 90%. And so all of these things happening simultaneously are telling you that, many of these markets are going to reverse simultaneously, and you're going to get some meaningful trends on the opposite side. And when you look at the big picture and you go back to the big picture biases, what should that meaningful trend be? So it should be a resumption of the dollar bear market, a resumption of the commodity bull market, and a preference towards emerging markets. So that whole which had sort of seen a minor setback in the last few months, I think is just waiting to come back, is how I'm looking at the whole thing.
Okay. All right. So what are you showing some charts, or you? Okay.
Yeah.
Okay.
So of course we try to measure the market. I use a lot of Elliott wave for cycles and also use momentum cycles with my own momentum indicator, which is sort of a smoothed rate of change. And the idea is to be able to see the market in terms of sine waves. So that is why I've put this chart up. And I also then use for the very long-term understanding of this deflation or inflation theme is to study the economic cycle, which is also known as the quantitative cycle or the long wave. And over a 50 to 100 year period, we expect it to go through periods of spring, summer, autumn, and winter. So the whole debate, I think, between that deflation to inflation shift in my mind was, because of all the debt problems, if we really had to have that collapse in asset prices, it should have happened during a strong dollar environment, which was prevalent from 2009 to 2020. And so I was still on the winter camp. And once, I think 2017, it became sort of first time clear that the dollar was entering a bear market. It did fall. Commodity prices rose, or even metal stocks in India did pretty well. But then all that sold off. And then you got a double top, I think, in 2020 March, which was the sign that, maybe things will turn. And that double top came after lots of readings. I think almost for a year, the dollar index gave readings of 94%, 96% on the sentiment. So I have that chart. I'll come to that. And so
what season are we in here?
So I sense that, and specifically for India, more than the US, I think India lags the US by around 8 years or 10 years in terms of where we are in the economic cycle and the kind of events that we get. For example, the US had the GFC crisis and the banking crisis in 2008-9. India had its own banking crisis between 2016-17 all the way till 2020 with rising non-performing assets and a non-banking financial market crisis, which then was bailed out very similarly, much smaller in scale.
Was that also the time that Modi
was
made
re-elected.
some notes. It wasn't Modi.
Yeah, yeah.
Where he made certain notes, took them off the market, certain cash, denominations, and was that part of the crisis?
Well, that did not cause the crisis because it played a role in sort of putting a pressure on stopping a lot of cash trades that take place in India. A lot of the economy runs on the cash market, and that sort of put a halt to that. But I don't think that is the reason why it happened. It had a lot to do with the previous business cycle. India had a boom between 2003 and 2011 in places like infrastructure, power, and many of those assets were stuck. But they were not being recognized as non-performing assets by the banks till the then Governor Raghuram Rajan said banks have to recognize it, and they recognized it in 2016, and then that led to the subsequent crisis.
I'm curious, in that experiment, has cash tax receipts gone up after that experiment of trying to eliminate the cash economy? Maybe, here we call it, underground cash, black market. So is the government doing better since they've made it tougher?
So it's a very, very good question. People might not have seen it in that same angle. We introduced something known as the GST tax, which is a singularation of all the state taxes and indirect taxes into a single tax, along with the demonetization. So when both these steps were taken, people initially thought this was bad. The fact is, post the pandemic and all the stimulus measures that everyone has taken, the tax revenues of the government in the last 1 year are way, way higher than anybody anticipated. So you hit it right there.
Okay. All right. So the season we're in with India being 8 years behind is what in India and what in the US? What would you?
So my sense is we are in the process of shifting between the winter to spring, and we may define this differently between economic discussion and between the stock market, because economically you would want to still see, well, the debt levels are still high and they need to come down. But in terms of stock market, because at the end of a crisis like the GFC or like the banking one we saw here, you could have completed the winter in stock market terms, because most stocks crashed and had their panic reactions to the lowest point. And so the equity market has already passed its economic winter, and it is doing what is known as wave 1 and 2, which is in Elliott wave sense, the first rally from our oversold condition on value buying, and then the second wave correction where people say, is it all really true? Are we still out of the woods or not? And that, I think that's the sentiment on the street. Whereas on the economic side, the reason I say that we have moved from winter to spring is we've gone from outright deflationary conditions in the commodity market to what I have called as reflation rather than inflation, because the monetary policy in combination with government intervention, which you also call as MMT or whatever name we may give it, is actually leading to an environment where prices of everything go up. So people say, inflation is bad. I say it's not just input costs that are going up, but it's also output costs that are going up and also labor costs that are going up. So in a sense, we are trying to bring down the debt to GDP by pushing up the price of everything in the economy. So that's a reflation and not just an inflation of some prices. And so it's a process.
Okay, so how has India been affected? What portion of this inflation or reflation, and I don't think you could call supply chain issues reflation, because reflation to me implies intervention, blowing air into the balloon, right? So what about supply chain issues in India? Are they being greatly affected by price, especially when we come to things like agricultural commodities, Rohit, where grain prices have absolutely gone parabolic, and I don't think there's anything a central bank can do to bring down grain prices by raising rates.
That's right. So clearly, yes, interest rates cannot play a role in bringing down inflation that is related to bottlenecks. But India being a net producer of agro-commodities, I think the impact becomes a little less. So we don't have like runaway food inflation out here, but we do have inflation at much higher levels. But our interest rates are also much higher than the US. So in that sense, But yeah, everybody, I think, including India, is running negative real interest rates. So no doubt about that. There's also a positive rub-off for India or some of the, like many of the emerging markets, because we are producers of commodities. So whether it is agro commodities, we are also metals, we do basic materials, papers, chemicals. We've started to get a lot of the chemical business where China was producing less, and there are a lot of incentives to make in India now given by the government, which are actually pushing people to start manufacturing for export. So actually, there's been a positive rub-off of all of this. There's been some impact of the, as you said, the bottlenecks on the auto industry where chips were not available for manufacturing, and so those pressure points were there. But most other parts have actually benefited from rising prices.
Okay, so you brought up the dollar, and you're calling it corrective. And I'm curious what your take is, your count is.
So let me go through all the wave counts from the Nifty, the Indian index, to then the dollar and commodities. Okay. So I have all of the charts coming up. Okay. So let me just swipe through them. Okay, so this is the big picture, and now this is an index of India which is backdated by an analyst in India all the way back to 1940s. And so I've tried to portray the 5-wave structure here and mark where the summer was and where the winter was. So the summer was in the 1990s for India, and US the summer was in the 1970s when you had very high rates of inflation. India had the similar conditions only in the 1990s. So like I said, around 12 years later. And then of course the winter period where we were correcting our debt problems went on till 2020. And so from there on, I'm trying to think in terms of, that we are in a spring. Now, when somebody looks at this chart, say, how can you say this is a spring? Because it looks like the market is rising. And there were a lot of attempts to change index components and make the market look good. So what I ended up doing, and a lot of people who are aware of how we study the economic cycle, is we either study it in terms of the index relative to gold or relative to the currency or relative to inflation. So I chose inflation, and I've divided the main index of India by India's inflation rate, which then shows us the long consolidation phases, which is this is your 4th wave summer, and this is your winter period, which is actually flattish because the Nifty did not go up as much as inflation during those years. So the best time to be in equities, as we all know that the best place to be to beat inflation is actually be in equity markets based on all historical studies. But when you do this kind of study, you also see when does that really happen? It happens during these bull markets. And that's somewhat of what has started from 2020, where equities are starting to outperform inflation. And so that is why I marked this as the winter phase, and what is starting now as a new spring phase for India. And I would say the same may have started for the US in 2009 in equity market terms.
Okay. Great look. Well, viewers are going.
Another value measure for India is to simply look at what has happened. Like I said earlier, we've benefited. That shows up in our earnings. But because of all the recent market fears, of course, the Indian index is down. If you actually measure it in terms of retracement, this is only a 23% retracement of the entire bull run from the bottom. And in terms of our bank index, only a 38% retracement. What is interesting here, though, this is the PE ratio at the bottom of the pandemic sell-off in March 2020, and this is the PE ratio now. And you can see this big decline here is happening because of earnings growth. Okay, so we've seen serious expansion in earnings because of the reflation. But markets rose till this point, which is October, and then of course the tensions around interest rates and then Russia have pulled it back a bit. But it's a very, very small correction, like I said, in terms of only being 23% retracement.
Shallow.
So what I'm presuming here is possibly this bottom is done, and I'll come to charts relating to why. So let me just go to the next chart. This, of course, explains what I said earlier, whether the shift from spring to from winter to spring is done by governments taking a decision on whether they want to inflate the debt or whether they want to allow it to default. And I think right now the environment is to allow to inflate it, which is why they are keeping real interest rates negative. So even though they may be in a mood to raise interest rates, I think as long as interest rates are negative in terms of real interest rates, markets will find a floor somewhere and continue to try and move higher. That's my basic thesis. So this is the Nifty index in India, the long-term wave count. I'm presuming we completed the one super cycle, I think, into March 2020, which is why I've marked 1 and 2 over here. And
yeah, we've got a long way to go.
Yeah, we got a really long way to go. So we started something completely new over here from here, and I've called this wave 1. So we've completed the first wave of a new cycle. We are going through the second wave right now for the last 4 months. And I think we are due now to start, or I believe we've probably already started what is going to be a third wave, which will go, way, way higher from where we are.
Okay, nice look.
I mentioned in the beginning, I also use the momentum cycles. I've created my own momentum indicator to measure. And what I found historically is that when you're actually in a bull market, okay, in a serious bull market, then most corrections, so you see the momentum behaves in 2 ways. One is it has small cycles, like in a phase where the market's not really doing well, it has these small cycles. Same thing happened here when it was flat in the 90s, which is your summer. You have many of these small cycles. But when you're in a bull market like this, then you have an extended cycle with multiple whipsaws, buy, sell, where the market really finds good support is at one of the averages. In this case, the 20-month average has worked pretty well in India. And we saw that happen again here in this next bull market from 2003 to 2008. The index went up 6 times and every sell-off found support at the 20-month average. Currently, that 20-month average was very close to around 15,100 for this month. Maybe it'll rise to 15,300, 400 for the month of April. And we made a low of 15,500 on the Nifty. So barely 300 points, 400 points close to the 20-month average, which is close enough, saying that the risk reward was very, very favorable at the recent lows.
Close enough for government work, no matter what who the government is. Or what country the government's from.
Yes. So I think this was a good risk reward point. Presuming we are in a bull market, I'm presuming that this is a bull market wave 1 and wave 2, not just for India, but also for emerging markets in general, which charts of which I'll just come to. So initially I did think, when I was still in a deflation mindset, I did think, well, if we do rally on a lot of stimulus, we go all the way to this parallel channel, 18,800 and maybe sell off in a 5th wave. A view that I've changed. And we did get to 18,800 and got a correction recently, but now my sense is that it's a bull market correction. Now, moving to the dollar, so that's the central thesis of everything. This is, of course, a dollar index chart from 1970s pulled out from Bloomberg and other data. And it's had a 7 to 9 year kind of cycle, bullish, bearish, repeatedly. And so the last 9 year bull market cycle went from 2009 to 2017. And from there, I was sensing it may roll over. We got a double top into 2020, and then I believe we've rolled over. Even though we've had a sharp retracement, I think the dollar index is in the process of going into a 7-year bear market. So if I took the top at 2017, I thought it will go until 2024. If I shift the base and think, no, the final top is in 2020, then it will go until 2027 based on this timeline. So in terms of the wave structure, there are of course 2 possibilities. One, earlier I was thinking that the 5th top is in 2017 itself, but if I tried an alternate way, that let the double top be the end of the 5th wave, because you also had a lot of sentiment extremes, so this could be some kind of an ending triangle in the 5th wave. Then the decline we saw in 2020 is the first leg down, which I've said is an A wave, and we are pulling back and kissing this rising trend line from the 2014 and 18 lows. And that's also a 70.7% retracement. The 70.7 is essentially a square root of 0.5 for those who are not aware. So many times in currency markets, I've seen this retracement work. And so that's close to where we stopped on the dollar index, with of course a DSI of 92%. So my sense is
even with the war, a lot of people are saying that, I think the euro's bottoming, but a lot of people say, well, this Russian-Ukraine war, it's not going away. I can't get long euro until I see, some type of resolution. What do you say to that?
Yes, so I have a euro chart coming up. So before I go to the euro, this is just for highlighting all the extreme readings in in the dollar index on the daily sentiment index. So we had multiple ones in, I think, 1920, but it rolled over only after the spike from the pandemic. So now this is the euro, the complete opposite of that. At point B, we had a DSI of 8%. And at the most recent point, we actually had a DSI of 5%. Now, there's this thing in Elliott waves that psychologically, second waves sometimes make a higher bottom on sentiment that is as bad or worse than the actual bottom. So if we actually make a higher bottom for the euro here, which so far appears to be true, and we have a lower reading, this sort of fits the thesis that this is a second wave based on just psychology.
Also, you need this count to manifest to be right about your views on the emerging markets, right? This could be the match that lights a candle for emerging markets.
Completely, yes.
Okay, nice.
So as we speak of emerging markets, I then switch to the emerging market currency index. This one's shown pretty, it's held out pretty well, I would say. Possibly doesn't include, there are of course two emerging market indices on investing.com. The other one fell much more sharply. Maybe it includes Russia. Maybe there's more weightage there. This one doesn't show such a sharp cut because of the others. And so most of the currencies are pretty well held out, I think, in terms of the huge rally we saw in EM currencies post the pandemic. And then you had this small little ABC decline, which I think is mostly complete. If I draw a downward channel here, it should be a pretty clean one. If I take a very clear line, it should be something like this.
What's your preferred fiat in emerging markets? Do you have one or two that you think will lead, that you would speculate?
Well, the one which is already leading, I think, is the Australian dollar. Okay. And the Brazilian real, and both may have to do with commodity price action because they're commodity producers.
Okay, thank you.
And of course, in the USD INR, that is the rupee itself, I do think we formed some kind of an ending diagonal pattern. So we were in the fifth wave for the Indian currency, the USD INR, for quite a while. It's really not sold off. It's come back to make a double top near around 77 during this Russian crisis. But it didn't go beyond that. So it sort of keeps us within this broader view. And I think once the next wave down for the dollar starts, you would see the USD INR pull back a lot more, possibly back to 65 or lower in the next bear market for the dollar. And that should be positive for Indian equities. Another thing I wanted to highlight in terms of reflation or hyperinflation, what we often see, and this is of course a chart of Turkey. We can see similar action in places like Argentina that has been perpetually hit by inflation. So when people don't understand why inflation is good for equities, I try to show this to them that initially when you get inflation, markets do react negatively, as we see with the blue line. And that's because they fear that, rising prices would hurt some parts of the economy. But if prices keep rising and the currency starts to fall, which is what we've seen here in Argentina, in Venezuela, wherever you had hyperinflation, is that persistent inflation eventually leaves equity prices much higher because the market starts to price in that, the entire GDP or sales or revenue of the companies underlying are going to be at a much higher level. So this is just to highlight that thought why we should be bullish equities in a inflationary environment, something that people often think that if there's inflation it's possibly bad. I try to say that it's not.
Great point.
Now, this is a chart I pulled from Elliott Wave International's recent reports, which is nothing but a ratio of the MSCI Emerging Market Index to the S&P 500, just to show that the ratio had come very close to the last time an emerging market bull started. So it's very close to that trigger point. And that then takes us to look more closely at what the EM indices are doing. And so this is the emerging markets, MSCI Emerging Markets Index, EEM, for those who want to look at investing.com. Right. And it formed a triangle between 2009 and 2020. And because of this triangle formation, I've marked it as a fourth wave because fourth waves are typically triangles, not having historical data, but this is the easy thing that we would do as Elliott Wave analysts, that if you spot a triangle, you presume it's wave 4 or wave B. And given it's a long-term setup, I've presumed it's wave 4. And from that point, I've been looking for the bull run. So what we have though then is the first wave completing in the EM index, wave 1, and it was falling in wave 2. In fact, admittedly, I didn't expect it to break this channel on the downside, which it has done as the Russian crisis built in. But the beautiful part is the most recent low we've seen in March is an exact 61.8% retracement of wave 1. So we've gotten to that point. And so I would like to believe that the bottom for wave 2 is done now. And also I want to add that events like, so this is again studies or socioeconomic studies done by Elliott Wave International, which have shown that events like pandemics, wars, these crises have always led to or occurred along with major market bottoms. So that's important because sentiment reaches an extreme. And of course, by the time the war is behind us, the market's not going to wait, which is why you need to really watch the structure and then take a call that the worst is over and start participating before the news flow changes. If you're really looking at timing a bottom in various of these markets. So that's looking at all those sentiment readings. I think that's where we are. We're reaching a very important bottom for markets, given the kind of news flow we've seen from the war front.
Your favorite emerging markets for this move would be what?
I think being in India, I will end up playing India because that's the easy one for me to do.
Okay. So you'll be
if
long,
I think of if I had
appreciating currency and
yes, then I would think Brazil. I would actually think Brazil because that has done the best on a 3-year, 4-year time horizon in the past. And so and it's also done a deep 61% retracement of its rally since March 2020. So I would think
it's already started to rally in the last couple months.
Yes.
So go ahead.
So as with the dollar impacting emerging markets, it should also impact commodity prices, which it has done. This is the Bloomberg Commodity Index, broke out of a long bear market in 2020 and has continued. The real question is, has it really topped out? Now, I think over time, everybody is aware that the commodity indices tend to have a large component of oil. So if I simply count this chart in terms of wave structure, I would start thinking that, we've done some kind of 1, 2, 3, 4, and are we really coming to a 5th? It is possible in oil, but it may not necessarily be in all the other commodities. Another thing is, in a bull market, you do get extensions. So should you stop significantly at 5 or will it continue to extend to 9? And especially if the dollar is rolling over, are there enough reasons for us to turn bearish on commodities? So possibly the only commodity I would be bearish from a couple of months perspective would be oil because it has overshot to the upside, but not necessarily across the board. Agro commodities are still looking very attractive. And metal prices, I think you've seen big spikes in maybe nickel, but not so much in copper. And so I wouldn't take a stance across the commodity basket, turning too bearish. So here's a chart of copper, which shows a very long consolidation in wave 2 of what I think is a 5th wave going on. Again, because of the long triangle that we saw between 2007 to 2020. And I've circled a part in the last bull market, which shows how it continued to extend without, a deep retracement. So people often say, if you've marked wave 1, why shouldn't 2 be a retracement? The way I explain it is that if you have a short retracement in a bull market, it's a sign of strength. It's not really a sign of weakness or that, you keep waiting for a deeper retracement. So small retracement is actually a sign of strength.
Yeah, doesn't accommodate people. Okay, nice look there too. I'll stop trying to sell rallies and copper. Thank you.
So the only place, the only place where I would think maybe we go through a correction or a consolidation is oil. So oil also does count like 1, 2, 3, 4, 5 on this chart. Okay, so I can say this is I'm not getting my annotation working. Why is it? So if I take this as 1, 2, I've taken this as 3, 4 because it's also triangular. So possibly this is probably the only commodity where I feel a 5th is done. Okay, and it may go into a second wave consolidation, which many others are doing right now, like copper is probably doing. But oil hadn't done it earlier, and it may therefore keep gyrating. Something like this, if I just think in my mind, could be the case. It'll retest maybe the breakout point and then presumably start a third wave much later. So oil could be the odd guy out, and but I don't think other commodity prices will go into a huge correction.
All right. What a great presentation. Is that it?
Yeah, I think that covers the most significant.
I think, yeah, I mean,
unless there are any questions.
Yeah, you didn't cover the zloty market, the Polish currency. I think that's the only thing you forgot, but great presentation. Thank you, whoever it was in our community that reminded me of Rohit, and you really clarified some things for me today. I appreciate your giving spirit and that you come here and share work that people could get great biases for and prep for these moves. I really appreciate it, Rohit. So I'm glad you came back.
Lovely, great. I really enjoyed being here and sharing these ideas. So thanks for the opportunity.
And I'll get in touch with you via Twitter to keep you in the rotation, so we don't have this kind of distance between interviews. Okay.
Surely.
All right, everyone, and the best way for people to follow you and your work would be at India Charts.
Yes, indiacharts.com is the blog that I write. It's also an app on the iOS and Play Store devices. So if people want notifications on every update that we write, they can use the app to get it. And then, of course, all social media platforms, we are there as India Charts.
Okay, so follow Rohit, and you'll have a clear telescope. And most of all, don't just count your pips, count your blessings. And I want to thank everyone for their attention. Hope we've added value with our speakers and our views this week. And if you're grateful for it, try the Trader Funding Program. And I'll see you guys Monday. Adios, Rohit. Thank you very much. I'll be in touch. Have a great weekend, everyone. Recharge your battery because things aren't going to slow down this summer. See you later. And get ready for the equinox, right? The vernal equinox coming up next week. Spring, if you've been down a little bit, is the time of rebirth and the time to get back on track. And that's why I bring guys like Rohit in here. And I'll see everyone Monday. Thank you. And thanks again, Rohit.